just coming. Oh, hello. Hi, everybody. Welcome to our CMAT bootcamp. Do you like my little entrance there? The steps, you see, because I'm in a basement down here in Cheltenham, Gloucestershire. Hope you're well. We're all good here. Talking to somebody who went down to Cornwall this weekend. He reckoned the whole population were down there last week, which is probably about right, really, because everybody's on their holidays, which is great. But, of course, the mortgage world continues onwards, and I've got some great topics for you, which, I think you'll like, actually, a few of these, because they're, like, a little bit edgy. But you got to be a little bit edgy, a bit like the guy on Fast Show, isn't it? A bit edgy, Fast Show, a long time ago now. You probably don't remember that show, do you? Unless you're watching Dave on telly. But I'm not here to talk about that. Okay, let's get cracking with the topics today. I hope you're well, by the way. Hope you're good and enjoying yourself. We're live on LinkedIn now, YouTube and Facebook, so we're kind of getting the word out there. The purpose behind this, of course, it's as it says up there. This is, where are we, over there? This is Mortgage Advisor CPD, somewhere out there anyway. It's all about learning and developing yourself, which is key to the whole game, really, isn't it? Now, 3 topics for you. I want to talk about the Megabroker. I want to talk about bridging. Then I want to pick up on fact finding for protection, which is the big area right now as well. So, I'm pretty keen on that sort of side of things, really. So let's get talking about the mortgage sector, first of all, for you. Let's talk about the mortgage sector and how things are there. Lots going on, of course, in the mortgage world, as you know. A little bit quiet in the summer. But what I want to talk about very quickly with you is the topic of mega brokers. Shall that be? Mega brokers. There we go. Mega brokers is my little sort of start of 10. Let's remove this property out of the way for you, because I'm going to talk about that later. I've got a nice fancy photograph for you to show you later on. Mega brokers. Now, it's a little bit of kind of like a throwback to history, really. Now, for those of you who've ever studied history at college, school, uni, whatever, you know that we never like to make the same mistakes. I think we probably are, if I'm honest with you. Let's explain what I mean. Now, the mortgage sector has always been profitable. There's always been a lot of money available for lending and advising on mortgages. That's been the case since the early 1970s. And it never will probably go away until AI gets its grip onto the sector. So what's happened over the past, of course, is that people want to make profit from this. People want to make money. And it's not just you and I. It's the big shareholders. It's the private equities. It's the banks. And back in the 80s and the 90s, in fact, the big banks, insurance companies, took over estate agencies. And you had the likes of Black Horse Agencies, Prudential Property Services, GA, Property Services. They all were piled on in, bought all these estate agencies with the intention of selling mortgages, because they sold endowments and everything on top of it. That model completely failed. And I'll remind you why it failed in a second. But now it's finding today, or this year, really, or the 2020s, let's call it the 20s, shall we, because that's quite a good ring to it as well. The same thing's beginning to spin around again, because you've got the demise of the banks and the building societies in the form of advising on mortgages. They're taking the lending risk, of course they are, but they're not wanting to take the advising risk so much anymore. Some are, but most are pulling out. In the last year and a half, they've pulled out dramatically with the branch closures, etc., which has left mortgage brokers to do the business. And there's mortgage brokers and there's mortgage brokers, and there's some big players in the mortgage market, and they're getting bigger. That's the scary thing. They're getting bigger. A couple of figures for you, which it's common information. This one, it's not a secret at all. Primus, very large network, very good network too. They've been valued by the people that value these people at £665 million. So there's Primus, for example, which is a mortgage network, financial services network. They've been valued by the people that value them at a lot of money. Now, they're not going to go around and get valued unless they're looking to sell or invest or merge or something, are they? And the owners of Primus, because there's a parent company, want the profits from mortgages to dominate the whole profits from the organisation moving forward. That's the owner of Primus. They've got 2,681 advisors. It's a big player. There's a lot of profit to be made there, and it's advisory profit. There's no lending going on there, so it's advisor profits. There's all the add-ons, all the ancillary products as well. A bit like the old banks, really. Do you think? Banks used to sell mortgages and add-on products, didn't they? Because that's how they made their profits. Now, they'll probably get bigger and bigger, and they've said they want to get bigger and bigger, and they'll probably get some private equity money, and they'll probably get bigger and bigger. They may list on the stock market. They want retiring brokers to maybe sell their brokerage back to primaries, and they'll become a great big conglomerate. They were comparing themselves to MAB, again, another great firm. I know a lot of people who work there. Really, really good firm. Again, they've been valued as well, oddly enough. They were valued at £687 million. How they do that's up to them, isn't it? But they've got 1,694 active mortgage advisors. So these are big players. So what you're going to find now is that these big players will start to hoover up small organizations, small brokers in the guise of a network at the moment, but they will become a company, and they will start to be a firm that gives mortgage advice based online, on apps, in branches, state agency, doesn't really matter. They will become what we call mega brokers, or I'm tagging mega brokers. And that's where the mortgage market will go, because you can't stop it, because money talks. And these people in the city, they want the money, they want the profits. And there's a lot of profits to make because the banks have pulled out, you see, so there's plenty of options. So what does that leave us then? Well, it leaves you as a mortgage advisor, if you're old and grey and you want to retire, you could probably flog your client bank to these people and make a bit of money, because they're hoovering them up right now on the mortgage side of things. The IFA sector's been doing that for a long time. They're getting big as well. So what you're going to have, I think, in the next few years is the mortgage market dominated by a few kind of players, really. You're going to have what I call the mega brokers. You're going to have it's my turn, I wouldn't go around using that one. The mega brokers, as I call them. I know they don't want to call themselves that to their clients, do they? These are big mortgage firms who give mortgage advice, broking advice. They broke the market and give more, and they'll have all sorts of divisions and subdivisions, and they'll get bigger and bigger. And I'll talk about it in a second. Then you've got your banks. Now, the banks and the building societies that are still lending will do it through AI stuff, the bots. They'll do it through artificial intelligence. They will nullify the people aspect, and they'll do it via bots. And they will. And they're already investing. I've talked about it before. And then, of course, you've got the niche kind of brokers. There's a sneak that one at the bottom there. The niche brokers, the smaller brokers, the boutique brokers, call them what you like. These are you guys, girls and boys, who offer a personalized service, a more specialized service. You look after people, obviously virtual, face-to-face, doesn't matter, but you do more of a specialized mortgage. You do difficult to place cases. You broke the market, semi-commercial, commercial, bridging, all those good things. That, I think, is the way the mortgage market's going. Do I see some ringbacks to the future past? I do. Mega brokers could become like the banks got back in the early noughties. They will become big. As they get bigger, they'll get very risk averse, because they will. They'll start to be run by compliance people, which is fine. I get all that. But what you find then is they have very, very structured processes, very little flexibility of operations, because they're so risk averse. Everything has a process, a step. They'll all be automated as well. You'll get quite a lot of mortgage advice being given in a very structured, systematic way, which is fine. A bit like when you walked into a bank 10 years ago and you're obtaining the mortgage. I remember doing some work for a large building society, and this poor cherub walked in London, and he was enduring a 3-hour mortgage interview, and he said at one point to the advisor, do I have to do this any longer? And that's the way it got, and maybe that's the way it will become. I hope not. I really do hope not. But you can see the way the world is moving, can't you? So there we are, a little insight into the world of mortgage brokers, or mega brokers. That's been useful. Bye. Okay, I say bye because I make these little snippets later on YouTube. Okay, so let's carry on, shall we? Let's go on to our next topic, which is quite an interesting topic, actually. I'll bring my photograph back up in a minute for you for our next topic. Because what I want to talk about now is the topic of specialised lending. Now, a lot of people in this sector of ours get confused because they do their CMAPs and then they think the world is around that, but it's not. It's much more specialised than that. So let's talk about auctions, bridgings, refurbishments, and all those good things. I just want to give you a quick case study. It's one I read during the week. A real situation occurred. And I want to talk to you about a case study which shows you, the mortgage broker, what can be done if you look beyond the remortgage, person buying house to live in with their family kind of model, which is great, but that's all going to be taken up by the mega brokers and the bots as well, and that kind of business will get sucked up quickly. because they'll price you out of the market. They will. They won't charge fees or anything of that kind of business. But this is something a bit more complex. It shares with you how, as a mortgage broker, you can move into the specialist area, unless, of course, you already are. So let me just share with you my thinking. Got a little picture here. This little picture of a property I found on the internet, which is a rather nice property. Now, this particular property was found by Mr. Khan. There you go. I'll leave that where it is. By Mr. Khan. So let me explain my little story for you. Mr. Khan, made up name, by the way, to protect the innocent, popped along to his hometown in Bedford and attended a property auction. Now, Mr. Khan often pops into the auction just to see what's going on. And he found at the auction there was loads of properties he hadn't even seen. He got caught up in the excitement of it all, a bit like Holmes under the hammer, isn't it? Anyway, he bid for a property which was 76 London Road. I'm making that up as well, obviously. 76 London Road. He bid for this property and he won the auction. He'd never seen the property before and he was all a bit confused. But he wasn't. He's a very experienced entrepreneur developer. And he bought this property. And this property is Edwardian, as you can see from the picture. So very, very solid red brick kind of thing, isn't it? It's currently configured into 8 flats or apartments. Here in Cheltenham, by the way, they call them apartments. We don't have flats here, you see, because it's Cheltenham. I don't know if Bedford's the same thing. I'm sure it probably is. And so they're all rented. It's very close to the hospital. It's close to the mainline rail station, so very quickly into King's Cross, I think it is. 20 minutes, probably 25 minutes, not that far at all. And it's a really, really good property to have. And he's really, really pleased about that. So he won the auction and he exchanged contracts, of course. And he put down a 10% deposit. That's what you have to do. And then he went home and got involved in family and all those good things. A couple of weeks later, he decided he'd better do something about this. Typical client, they leave it to the last minute, don't they? That's just the way it goes. So he contacts his mortgage broker and says, help, I need some money, please, to buy this house. Now, if any of you are involved in the world of property finance, you know full well it's going to take a lot longer than 2 weeks to get a mortgage offer and complete and all that business. A lot longer. Yeah, there's stories of what mortgage offers in 2 days, but pretty exceptional. So the standard mortgage was not ready, or buy-to-let mortgage, because they were rented. In fact, there's 8 flats, all leasehold. So although it's a property, he bought the freehold effectively, didn't he? There are flats in there which should be rented effectively. It's not, they're not sold. He owns the whole property. So he goes to his mortgage advisor, and Sima, who's the mortgage advisor, lovely mortgage advisor, comes up with the trumps. So what does she recommend first of all? Well, she recommends that Mr. Khan applies for bridging. Bridging is great. People think bridging is just to break chains, all that kind of stuff, but it's used for many other reasons. In this situation, the bridging finance that Sima organised allows Mr. Khan to complete the purchase within 14 days. That's pretty much it. So bridging is secured and he completes within 14 days. Yeah. And that's completing, by the way. That's not like mortgage offer. That's everything. It's done. Bridging is very quick. And what she did is she liaised with Mr. Khan and explained how it works. She said, look, bridging is very quick. We'll do an automated valuation model. So just go online to value the property. No need to send anybody out. And there's no affordability checks as such. We'll do a credit search on you, those things. But the fact is, we're not worried about you making monthly payments. There is a fee and there is an interest rate involved, of course. But what the bridging company are looking to do is to look for an exit strategy. They want to know how you're going to pay this bridging loan off before the end of the term, and they organise a 12-month term for this one. So he's got to pay the whole lot back. You don't have to make any payments. So, they're not worried about that, which is pretty cool, isn't it? They secured it on the property. There's plenty of equity there. They secured the loan on the property. So it's a first charge bridge. It's no big deal there. And Mr. Khan's well pleased about that. He buys the house. He then kind of moves on in and makes sure the tenants are okay, keeps it ticking over as is. So a little bit of, cosmetic improvements just to make sure the property's okay. But now comes his ace card. Mr. Khan, of course, is an entrepreneur developer. He kind of like gets a kick out of making properties look great and renting them and giving homes to families, and good man for doing that. So he decides to apply for planning. to do some really big works to the property. He reckons he can really spruce up the flats inside, make them look lovely with some double glazing, etc. Do the sash windows, but he reckons he can get a couple more apartments out of the property as well by reconfiguring things. But there's a lot of land here as well, so he thinks he's able to hive off some of that land and create a self-contained property, freehold property from the land that the property's in. Because when people tend to rent flats, they don't tend to have they don't want large gardens. Their life is very different. But of course, he needs to apply for planning for that, and it's going to take time, and there's money involved. So again, Simon comes up with the goods, and what she does here is organises a refurbishment loan, a refurb, we like to call it, refurbishment loan. So you can have different types of refurbishment loan, and that basically gives him 100% of the cost of the refurbishment. Pretty cool, huh? So he gets his money, and it's all 100%. So it's all done. It's all based upon, you see, the final value of the property. So there's definitely security going on there as well, and it's a great thing. So he gets the money. He's able to secure a really good builder, pay them in advance, make sure the work's been done, and everybody's happy about that, really. And he gets the builder doing all the work that's required, builds the extra house, gets the extra flats, gets those rented out to a local family that moves into the house. He loves all that. He's got a couple of city dudes renting the new penthouse that he's built in the loft, and they can catch the train, get into King's Cross in 20 minutes. So they're loving it. And he feels good about his life because he's done some really good things. What he then does is finishes the whole thing off. Simon comes up with the goods again, and she then remortgages the whole thing. Because don't forget, this property is now glorious. She remortgaged them into buy-to-lets. There you go. Buy-to-let mortgages, because these properties are owned by Mr. Khan, but he rents them, so they're buy-to-lets. Now, the buy-to-let loans, of course, gives him a lump sum. He then uses the lump sum in order to pay off the bridging. It's all done within the 12 months. Bridging company's happy. They've made a good fee, and there's good interest added. They're okay with that. Mr. Khan now gets a really low rate buy-to-let mortgage, or mortgages on the property, because there's two securities now. And Simon has given good advice, and she's done all right there, because the last part, of course, is probably the easiest part. So if you think mortgage broking is about helping first-time buyers buy their first house with a loan from Halifax, think again. The world is moving on. There's an awful lot of changes to planning permissions. There's a lot of properties in there that need refurbishing. There's plenty of housing stock in this country, just a lot of it's not usable. So there's plenty of opportunities to convert commercial into residential, because commercial itself has lost its allure because of online retailing. There's a lot of marketplace movements going on. And this kind of stuff is easily available now. There's a lot of lending available. There's a lot of lenders that do this, and they're really pushing their products. I'm working with a couple of clients now on these bases, helping their BDMs, because their BDMs really want to promote this to you, the mortgage broker, to show you what you can do with their lending. And this is just kind of the detail under here, of course there is, but it just kind of shares with you what can be done by the likes of people like Mr. Khan, who will be a client for a long time if you look after them. And by the way, Simon's made quite a lot of profit there. She's worked hard for this business. This is not easy business. This you have to make a lot of calls, all things, but she's earned good money. Hope that's useful. Bye. Did you like that one? Did you? I hope so. I hope that was great for you. Okay, let's move on from that topic, shall we? Let's move on from that topic and give you a couple more topics, I think, before we wrap up today. How are we doing for time? Yeah, we've got a few minutes left, which is good news all around. So I want to do a couple of videos for you on some other topics, really, just to keep you comfortable. Now, one thing that is moving forward a lot this autumn in the mortgage market is the idea of protection advice. Now, the idea itself is not new. Of course, we've been giving protection advice for years. But the regulators are starting to pick up the fact that they do need to get people better educated. A lot of brokers need to be much better educated when it comes to protection. The CMAT was not right just for protection, it was. So they're encouraging more studies. And what they've done cleverly is they beefed up the CMAT 2 to have a lot more protection in there, which is absolutely the right thing to do. And there's a section in there on the advice side of things. How do you give advice on protection? How do you go about doing it? I want to talk about that now for a few more minutes. If you allow me to, we'll probably go on for another 10 minutes, so 10, 15 minutes, if you're okay with that. I'm all right with that. If you want to, you can always pause, come back to this, because it's always recorded on YouTube and LinkedIn anyway. So what's the first one? I want to remember to remind you of, we're talking about protection advice here. We're talking about giving advice on protection, which is key. So we're talking about protection advice. Here we go, protection. And the key thing here, of course, is to integrate it with your mortgage advice. We've talked about that before. And I talk about SIGAR as an acronym to help you to remember how to do this, really. So I talk a lot about SIGAR. There you go. This is how you give protection advice. You won't find that in the textbook because that's not really textbooky, is it? But it does help you. And the first one I want to take a look at is this one here, the C. Now the C stands for the current situation. So you've got to find out what the current situation is of the client. What is their current situation? You've got to do a fact find. Find out where they currently stand. In other words, before you start even thinking about protection advice, where they currently stand. And you talked about the mortgage, of course you would. This is probably integrated with your mortgage advice. It may be afterwards, it doesn't really matter. But there's a lot of factors that you need to take into account when thinking about the current situation of the client. I want to have a look at some of these then quickly with you, just see what you think. All the usual culprits, like the person's age, would come into it. So you need to take a look at their age. How old are they? What ages are they in their life? Does that indicate a need for protection advice? Because you're just doing a fact find at this stage. Marital status, of course. There we go. Marital status comes into this as well, because that might indicate a need for protection advice. They might be married with dependents. They might be divorced. So they might need to rearrange some of their wills, maybe. There's all sorts of issues around marital status as well. The big one, of course, is children and dependents. Children and dependents, yeah. Because if somebody's got children or dependents, then they need to have protection. They need to have life or health insurance protection, because their children are relying upon them to look after them. Well, it's been like that for centuries, hundreds, thousands of years. Dependents, of course, don't have to be children. They can be elderly people as well. So if there's anybody dependent upon you, then you need to think seriously about protecting yourself. Carers come into it as well. And you take a look at the subject of wills, because we're talking about the current situation. So wills, has the client made a will? If not, when? Was it updated recently? Have they remarried or divorced? Does the will need organising? Is there an IHT funding issue coming from this as well? If they've got a lot of assets, do you need to fund some inheritance tax? Don't forget guardianship of the children as well, because a will not only will determine where the money goes, it'll also provide a guardian for the children if both parents die simultaneously. That's something to think about as well. So that's another area. Let's change the pen for you. Here are a few more factors. The client's health, of course, would come into it. Obviously, if they're very, very ill health, you probably won't be able to get life insurance. But the point is, though, you've got to take a look at their health situation as it stands. On that thing, let's come over here. Vulnerability would come into it as well. Vulnerability. Big thing now with the FCA, of course it is. There was some research last week I read about that there are 27 odd million people who are vulnerable in some shape. I'm not quite sure if that's the case, but that's almost half the population, the adult population anyway. Vulnerability is defined by the FCA as somebody needs extra support and help, of course. So if you can find the client is vulnerable, your network or your principal has defined that for you, then you need to take them to the next stage to look after them carefully, give them some extra assistance as well. And the client's occupation would come in here as well. Occupation, there you go. Client's occupation would determine the need for protection as well. Do they have any employee benefits? Do they have death in service, some health insurance maybe? So check out the benefits in kind they get from being an employee. Do they run their own company? Are they directors, shareholders? If so, there might be a shareholder protection or partnership protection need that the client's got as well. So that all gives extra needs that they might have as well. And then we get down to the quantifying side of things. And what we're now starting to do is get into the I and the G. Now the I is ideal and the G is the gap. You find out their current situation, you then find out what their ideal situation should be, then you expose the gap and you coach the gap. That's how you do it. So we're fact finding now. What we're starting to do now is start to look at the ideal situation to examine the gap. Because what we need to find out now is whether the customer's got any capital or other forms of income or other policies as well. So first of all, do they have any capital which they're not using for the house purchase that could be used in the event of a rainy day? So we're starting now to look at the gap a little bit here, aren't we? Because if they've got capital, they could probably use that for 6 months, a year, or whatever it is, in order to provide for themselves. If they've got any unearned income, so any unearned income from other sources, like renting a property, for example, unearned income. If you're renting a property, then if you're ill, or you could still get the money coming in, or if your wife dies, you still own the property, there's still money coming in. So it's not exactly though you're losing a salary. So that's something to take into account as well. Liabilities, of course, in their own right. Let's change the colour again. Liabilities. So no doubt, have you already covered the mortgage? So liabilities. So the mortgage, of course, would already be looked at as a gap, wouldn't it? Because they haven't got cover for the mortgage, they need cover for the mortgage. There's the gap. As simple as that, really. It's a cigar in action. And the other liabilities do they have? Look at the term as well. That would come into it. State benefits. Are there any state benefits they're currently applying for? Probably not. They wouldn't be applying for a mortgage. That's the case before, if they're getting state benefits. So that's probably one that you'll need to look at later, because you're examining the gap. People will have state benefits in the event of death or illness. And the last one, really, we'll squeeze that one just down here. Can you see that one? You can. The last one is, do they have any existing plans? Do they have any existing plans? There you go. Life policies. Any products, obviously, from work, of course, but do they have any existing life assurance that would help to reveal the gap? Because we're trying to find out what the current need is. And we now know, we've got Mr. and Mrs. Khan, a couple of children. They'll need some protection there. They've got a mortgage. They've got all sorts of need for income and health and life insurance. Ideally, they need all of that. We don't know how much yet, but there is definitely a gap. Let's quantify the gap next. So that's the fact find. That's a pretty standard fact find, really. And what happens there, you'll probably have pages in your fact find already populated on your system. You just need to answer the questions, which is great. Not a difficult thing to do, to find out where the current situation is. Then you get into the bit I think you're paid to do, really. I mean, anybody can fill in a form. Clients can fill in forms themselves, can't they? Many do before any kind of meeting that you would have. But what you now want to start doing is start to reveal the gap. In other words, what should be the ideal situation, and then what's the gap, and start to talk about the gap. And there's two parts to this, really. The first part is the mortgage, which is, lend money, no protection, need protection. There's the gap. But the other one is protection for family protection, general protection, which many mortgage advisors leave out. I'm not going there yet why that is the case, but you may want to become a full protection advisor, and you do need to think about the family protection as well. So my concept really here is that once you've done your fact finding, you then move into more of a coach role, more of a coachy role, and you start to ask questions. You start to ask questions in order to talk about what ideally they need and want. Let's just press my button on this camera over here. There you go. So you start to ask questions about what they ideally want, and then what the gap is, and then how important is it for them to plug the gap, whether it's really important for them to do something about it. It's done through coaching. And I've just got a series of questions here that I'm going to ask you on the camera, because you're right there for me. I'm going to ask you to see what your answers to these would be. So the first thing is, if I've got Mr. Khan again, let's go back to Mr. Khan in Bedford, and we asked Mr. Khan the question, Mr. Khan, if Mrs. Khan was to die, how much would you miss her income? That's a good question to ask, isn't it? And likewise, Mrs. Khan, if Mr. Khan was to die, how much would you lose or need his income if he was to die? Mr. Khan, what debts will you need paying off in the event of your death? I know you know all the answers to these things, but you're coaching now. So that's a good question to ask. If you were to die and you paid off the mortgage, how much would that save you each month out of interest? And therefore, how much would you not need to cover in the event of death? That's all, wouldn't it? If you were to die, what monthly bills would stop? So Mr. Khan, if Mrs. Khan was to die, what monthly bills would stop as a result of that? Sometimes they do, don't they? So all in all then, how much income would you need then if Mrs. Khan was to die tomorrow? Now obviously you'd have to have good rapport for those questions, and you have to sugarcoat them as well. But you now start to just iron out what they need. You're quantifying the amount of cover they need. Simple as that, really, through coaching. Oh, how long would you need this for? This income that you're replacing when Mrs. Khan dies. How long would that be required for? Bearing in mind the ages of the children, etc. Would you want a lump sum, or would you want income to help you to plug the gap there? It's another question to ask as well. If Mrs. Khan was to die, what sort of income would she get from other sources? What would she get from the state? What would she get from her company? Should we take that off of the amount that we think we need? So you're starting to really quantify cleverly the amount of cover that's needed. So bear in mind all those things that they're going to get elsewhere. How much lump sum do you think you now need? Let's make a note of that. Oh, out of interest, how would inflation affect that for you over 20 years? What would you be concerned about with inflation? Okay, so we need to provide this amount of money then, do we? And hey presto, you've quantified the amount of cover needed. It's like that. Yes, you can get templates that do that. And most risk-averse firms will provide you with templates where you've got this great big template with questions on it, and the questions have boxes on them, and you start to fill in the amount of cover. So how much cover is needed, what state benefits are received, what debts are paid off, what's the net amount of cover needed, how long for. So you get all this stuff, and you need to fill those in if you're given them. Of course you do. It's actually your job to do that. But all I'm saying to you is when you start to reveal the gap and identify how much is required, the ideal situation, then of course you need to start quantifying, and you do it through coaching. Works really well. So that's an example of how you can do that. So that's the sales process, if you like. That's the fact find advice process. Make sure you get the current situation in the form of a good fact find. Of course you should. Then you want to find out what the ideal situation is. What do they need? And then you quantify it through questioning, and then of course the gap itself gets revealed. How much cover do you actually need? That's the protection gap, and then you can start to talk about that. Occasionally, you might want to start talking about proving why they need it. What would happen to your family if you were to die? What would be the issues, the problems, the concerns? You may need to go there as well. If Mr. Khan hasn't bought into the whole idea of protection, you might want to do that right at the beginning before you introduce the fact find, before you start asking details. What I want to talk about now is protection. Out of interest, Mr. and Mrs. Khan, what would happen to your family if one of you was to die? What would be the implications to you? How would you struggle? What would happen to the kids? So they're buying into the whole thought about protecting themselves before you start going into detail. Great. I think we'll wrap up at that point. Bye. There we go. I hope that's been of use to you. Nice little action. But we're putting a lot of this onto our new bootcamp on protection, which we're launching in September. A lot of videos on protection products and how you can organise your protection advice part of your practice and get that done really well for you. And we've got some new additions to the CMAP material this month as well, which is great news all around. Well, I think we'll wrap up. Gosh, we've been going on for half an hour live stream. Wow, that's a long one, isn't it? I hope you've kept with me. You'll be able to watch the recording, of course you can, because that's what we want to do for you to help you out moving forward. Enough of this. I think I'll wrap up now and see you next week at 12 noon. Bye. And I've got to go down the stairs. See you later. Bye.